Attempt number 70 million at recording this video. Every time I've done this, I have had some background noise, and I've now just decided to give up because I'm not going to get it to go away. Quacker over here is my little birdie, and you're just going to have to deal with it. So, in any case, moving right along. Last week, around 10 days ago, did a video where we looked at the S&P 500 1-hour chart and did a little bit of work around what at the time was a potential long setup on the 1-hour chart. So what we saw there, at the time I was pointing out the potential for a falling wedge to be a potential long entry, right? So I've not changed any things. I've added a few more annotations on this chart. Since then, I've basically just added on some resistance levels. I'll take that one away. But I've just basically added on some resistance levels that that I would then use as triggers to add to the trade. So, hey, shush. So the theory was that this was a buy signal that we got over here, right? And one of two things would happen. There were two different scenarios that we sort of anticipated looking at history, looking at the previous trade action of this particular instrument. And the first one was that we have a buy signal being generated by the stochastic. We need a little bit of patience and eventually the trade works out, right? The second scenario, which is actually quite ironic, that we spent quite a bit of time looking at this in the previous video, and I'll link that video to this one in the description or whatever below if you want to have a look at it. But basically what we said is we got a buy signal there and we ended up buying right as a sort of secondary trend was forming to the downside, or as a longer term correction took place. Now keep in mind this is a 1-hour chart, so a longer term correction here is a space of 2 days. And we actually managed to get 4 sort of triggers to get a long position on by using the stochastic alone, right? And we would have probably used various techniques to have them confirm as triggers on the on this little downtrend. So basically, when we spoke about it last week, we said that it would have been a good trade here if you sort of added to this position as it was running down, and then you would have had a nice average price to go up, right? Because when taking this trade, which is your falling wedge formation, you don't know which scenario it's going to be. Are you trading this scenario where you have the same turnout, where you have a buy signal and like a valid buy signal on a number of different metrics, and then a bit of patience is needed, maybe a day or so, and bang, the trade works out? Or are you buying into this scenario where you get your first buy signal and then it kind of trends against you for a couple of days and eventually the trade works out, right? So the idea here was that there's no real way of telling which one of the two scenarios it is. So we then spent some time talking about how it is probably better to plan for this scenario rather than expect this scenario, right? So here we have just one buy signal and the trade works out. Here we have one buy signal and the trade actually doesn't work out immediately, and you end up with 4 buy signals before the trade actually works. So rather than basing your risk management sort of criteria for this particular trade on taking the entry on this candle, which would have been the close above the breakout of this falling wedge, or you could use this candle, which is the one's confirmed that you have a turn of the stochastic. Instead of saying, okay, cool, I want to take a long position here with a target that, as we can see, it was never actually reached, right? There was a reversal before that target came. So, and you would then put your stop loss at the consolidation extreme, right? And that would be below this sort of 3009 level or 3007 or whatever the case is, 3008, to be a bit more conservative. And then that would be your 2% of capital risk rule. So you'd end up with quite a big position there, considering this is a 1-hour chart. And the sort of thinking in the previous video was that is unwise, because we don't know which scenario we're in. Are we in a situation where we have this longer term slight kind of pullback, or are we in a scenario where we run? So the wise thing to do in this situation, as discussed, was that we take 1/4 of our position size here, and we anticipate that we could have in total up to another 4 sort of triggers on the stochastic. So we want to take 1/4 of our position size, and we want to make sure that we stop out only if we get a stop loss level under something that's significant. So 2961 or 2984, 2961, I think we chatted about a little bit, because that was also sort of a significant previous support level in the past, right? So instead of taking full position here, we take 1/4 position, and then the plan would be that if we get triggers above the 80 level on the stochastic, we could use those as opportunities to add to the long position in the scenario that we have this breakaway and we don't have a longer pullback. So we take 1/4 position. If the market breaks to new highs and gives us triggers above the 80, we then add to that position to get our second, third, and then eventually fourth position, so that we're up to full size. That didn't happen, right? So we didn't actually ever see a break above these highs. So we never added to this position while the market was rallying. Instead, what happened was actually kind of exactly the scenario we had anticipated or planned for, like the worst case scenario, where we had another trigger below 20 on the stochastic, and another sort of, there would have been a trend line set up, so that would have gotten you long in there. And again, boom, that failed. Again, we traded below the 20 on the stochastic. Again, they would have given you a buy signal. This time it looked like, yes, you really got it. And by this time, you've now had 1, 2, 3 entries. You've got a sort of semi-decent volume-weighted average price. So you would have been in here somewhere. But again, a fourth trigger below the stochastic. And what's interesting here is you can actually see that those are lower lows and those are higher lows, right? So you've got a little bit of hidden bullish divergence there as well. And then, boom, we have the final break up to new highs, actually, which is what it made last night. So here, that was not actually a signal that never came below 20. So what is interesting here is that this scenario where we saw 4 dips below our 20, we saw another 4 dips below our 20 level here again. And that scenario is kind of the one that when we looked at this trade initially, we thought, wait a minute, this is a high risk trade because this is what happened last time. What are the chances that this happens again? Let's make sure that we plan around that, and we plan transaction costs, carry costs of the trade, interest rates, swaps, and all that kind of stuff, as well as position sizing. Let's do it right so that we can make sure that in this scenario we don't get carried out. And that's kind of exactly what happened, right? And it managed to go on and make a new high. Also, just for reference sake, I'm not sure how much time I spent on the daily chart last time around, but there is also this longer term kind of setup. I'm going to now actually go ahead and delete a lot of these lines. Deleted the wrong one, just to clear up this chart so we can actually have a look at what's going on here. Yeah. So we had this longer term setup, which is I put it on Twitter a couple of times already, where there was this kind of like bull flag situation with the target of 30.31, and we can see that it's made a couple of more bull flags on the way up, and we're almost at that target now. So that's also part of the reason why our bias is long, and we're happy to use this level, this 61 level, or 29.61 level, as a significant stop loss, because that was the previous all-time record high, as well as a support level here. So that's kind of a little bit of context around. So that's maybe a slightly better chart. It's maybe a little bit of context around. Now I've changed the size of this thing. Goodness gracious! Around the trade that that we discussed last week, and just a bit of an update on it. So for those who were interested. And I think that this just shows, the crux of what I had spoken about in the previous video was not necessarily the trading opportunity as much as it was just the planning of your risk management around what happens if this particular setup doesn't work. Let's go back and look at how this instrument, whether it's a stock or a currency or an index future or whatever it is, let's go back in its own history and see what its pattern has been like over the last sort of recent while. And let's plan for around perhaps a repetition of that pattern. And that is kind of, in this case, what saved us here from being stopped out of a great trade, but at the very tip top, because we took a bull flag entry right here, and then only a couple of days later did the trade actually work, right? So on a daily time frame, you might have waited for this support level to take a long, or on a 4 hour or whatever the case is, it might be a little different. But on the 1 hour chart, you look at this little flag, which was, I've now taken the annotations away, which was here, right? And you think, oh wow, this is it. Meantime, you've actually got a much larger sort of thing at play, and the real opportunity was in the repetition of this particular pattern, which, and you can see it's not exactly the same, but we kind of planned for something like this to happen by making sure that we don't get overexposed right in the beginning, and that we can add four times to the trade in a scenario where this happens. So yeah, interesting. Obviously, I think that this is going to spark a bit of debate. I hope it does, around adding to losing trades, around averaging down. Obviously, adding to a losing trade is not a good idea. Averaging down is an even worse idea. My view here is that this is different because we'd actually planned to take 4 entries, and we planned for the trade. We anticipated that this is a possibility, that if the trend moves against us for a while, we can add at better prices, but if the trend moves in our favor, we can add obviously at worse prices, but we can buy into that strength, and either way we would have added 4 positions over a period of time, using the stochastic oscillator to give us triggers under the different circumstances. In a bullish trend, we would be buying on the breaks above the 80. In a bearish trend, we would be buying on breaks below and back up above the 20, right? So yeah, let me know if you have questions, put comments, let's spark a debate, let's get some thoughts going. I'd really love to know what you guys think. I hope that you find this stuff helpful. Like, share, I don't know, do all the things, and have a wonderful day.